Okay, let's unpack this stack of articles you sent about the Net Zero Asset Owner Alliance. Investors aiming for net zero emissions by 2050 talk about putting your money where your mouth is. It's a massive goal, and I have to admit, I'm a little skeptical. Are we talking real change or just a bunch of greenwashing?
It's definitely an area ripe for skepticism, but what's fascinating here is the sheer scale of their influence. We're not talking about a few eco-conscious billionaires. This alliance boasts 88 institutions managing a mind-boggling $9.5 trillion in assets. These are giants like Alliance, AXA, even CalPERS, California's Public Employee Retirement Fund. They have the potential to reshape entire industries.
So, not just a drop in the bucket then, but grand pronouncements are one thing. What have they actually done since this alliance started 5 years ago?
This is where it gets interesting. They've actually made some tangible progress, reducing emissions from the companies they invest in by an average of 6% annually since 2018.
6%. Honestly, that doesn't sound like much.
It's all relative. Think of it this way. If your city's budget was suddenly slashed by 6%, things would come to a screeching halt. Now apply that same logic to massive industries. Plus, that 6% reduction, at least within their portfolios, puts them on a trajectory to meet the Paris Agreement's 1.5-degree C goal.
Okay, I'm starting to see the potential impact, but how does this actually work? Do they just threaten to pull funding if a company uses too much coal?
It's a lot more nuanced than that, thankfully. They've developed detailed frameworks for everything, setting targets, measuring emissions, and even advocating for policy changes. Transparency is key. They expect companies to be open about how they're transitioning to cleaner practices.
You keep mentioning policy changes. Are they trying to become climate lobbyists on top of everything else?
In a way, yes. They're realizing that shifting investment portfolios alone won't cut it. They're calling on governments to step up with supportive policies. Think carbon pricing, phasing out fossil fuel subsidies, and regulations that make net zero the default. They're trying to reshape the entire playing field.
So they're not just playing the game, they're rewriting the rules. But what does that actually look like? Give me an example.
One of their key initiatives is something called the Target Setting Protocol. It's a framework, regularly updated, to help investors align their portfolios with that 1.5-degree C goal. And it's not just a suggestion. 81 members, representing a whopping 98% of the alliance's assets, are actively using it.
Okay, so they're putting in the work to figure out how to measure and track progress. But how do they get the companies they invest in to actually change their ways? That's the real challenge, right?
Absolutely. They use a multi-pronged approach. First, there's engagement, actively talking to companies, pushing for clear climate commitments, and encouraging them to develop robust transition plans. Think of it as a roadmap to a low-carbon future.
So they're providing guidance, not just demands.
Exactly. And it's not just talk. They're putting their money where their mouth is, significantly increasing their investments in climate solutions from $87 billion in 2020 to a massive $380 billion in just 2 years.
Wow, that's a serious chunk of change. But are they just throwing money at the problem?
There's a strategy here. Remember those transition plans we talked about? Part of their strategy is investing directly in companies and projects actively working on those solutions. Renewable energy, sustainable infrastructure, things that will actually make a difference.
So they're putting their money where their mouth is, at least to some extent. But we were talking about policy changes earlier. What are they doing on that front?
They're realizing that changing investor behavior is only part of the equation. They're pushing for government action to create a level playing field and accelerate the transition to a low-carbon economy. One of their biggest areas of focus is carbon pricing.
Okay, before we get too far, can you break down what carbon pricing is and why it's so important?
Absolutely. In the simplest terms, carbon pricing puts a price tag on carbon emissions, making it more expensive to pollute. The idea is to incentivize companies to reduce their environmental impact.
Makes sense. Hit them where it hurts, their bottom line.
Exactly. The NZAOA is pushing for two main types of carbon pricing: carbon taxes and emissions trading systems. Both aim to make polluting a less attractive option financially, encouraging investments in cleaner technology.
Okay, let's unpack these two types of carbon pricing. A carbon tax seems fairly straightforward. You pay for what you pollute. But what are emissions trading systems and how do they work?
Emissions trading systems, sometimes called cap and trade, are a bit more complex. Essentially, you set a limit, or a cap, on total greenhouse gas emissions allowed. Companies can then buy and sell allowances or permits that let them emit a certain amount.
So it's like a pollution stock market. Companies that can reduce emissions cheaply can profit by selling their extra allowances to those struggling to meet their targets.
You got it. It incentivizes finding the most efficient ways to cut emissions overall. Now, the NZAOA isn't naive about the challenges of implementing carbon pricing. They know there are concerns about costs, potential job losses, and ensuring fairness, especially for industries and communities heavily reliant on fossil fuels.
Those are valid concerns. It can't just be about punishing companies or putting people out of work.
Exactly. They're advocating for a just transition to make sure workers and communities impacted by the shift away from fossil fuels are supported.
So how are they proposing that we ensure a just transition? What would that look like in practice?
They argue that carbon pricing revenues should be reinvested in initiatives like job training programs, support for renewable energy projects, and other measures to ensure a fair and equitable transition. The goal is to create new opportunities in a greener economy.
Okay, I'm starting to see how complex this all is. We've covered a lot of ground here, from the alliance's goals and strategies to the intricacies of carbon pricing and this idea of a just transition. I'm definitely starting to see why you find this so fascinating.
It's a fascinating case study in how financial influence can be leveraged for systemic change. But we've only scratched the surface.
I'm ready to dive deeper. Where do we go from here?
You're right. We've just dipped our toes into the complexities of this alliance's approach.
Yeah.
We talked about carbon pricing in general, but the NZAOA gets into the nitty-gritty of how these policies should be designed. They're not just calling for any carbon price. They want a system that's effective, equitable, and avoids unintended consequences.
Okay, so walk me through this. What do they see as the key ingredients for a carbon pricing system that actually works?
One of their big things is fairness and minimizing what they call competitive distortions. They argue that carbon pricing should be applied consistently, regardless of the industry or where a company operates.
So no free passes for big polluters just because they've been around longer or have more political clout.
Exactly. A level playing field is crucial. They're also really big on transparency. They believe governments need to be upfront about how those carbon pricing revenues are being used, building public trust, and ensuring the money is actually going towards a greener future.
That makes sense. If people don't trust the system, they're less likely to support it, right?
Precisely. And to make sure businesses can plan for the future, the NZAOA stresses the need for a predictable price signal. If companies know what to expect, they can make long-term investment decisions with more confidence.
So it's about providing clarity and stability, not just slapping on a tax and hoping for the best.
Exactly. They've put a lot of thought into these design principles. But you're right, getting governments to agree on something as complex as carbon pricing, it's a huge challenge.
It feels like herding cats sometimes, getting everyone on the same page, especially with something like climate change, where the stakes are so high. So with all their research and recommendations, how much influence are they actually having in the real world?
It's always tricky to measure direct influence, but their voice is definitely being heard. Their reports and recommendations are frequently cited by governments and industry publications. Their size and the fact that they represent such a huge chunk of assets give them a seat at the table in policy discussions. Plus, remember how I mentioned they're part of this even bigger coalition called the Glasgow Financial Alliance for Net Zero, or GFANZ?
All right, strength in numbers.
Exactly. That amplifies their influence significantly. By working within this massive network of financial institutions, they're able to exert more pressure and drive change on a much larger scale.
That's encouraging. So they're not just a lone voice in the wilderness. But let's be honest, carbon pricing is just one piece of the puzzle, right? What other policy changes are on their radar?
Oh, they have a whole wish list. Phasing out fossil fuel subsidies is a big one. They argue that it doesn't make sense to financially support an industry that's actively contributing to the climate crisis. They're also pushing for increased support for clean energy development, promoting things like renewable energy infrastructure, and making it easier for companies to invest in green solutions.
So it's about creating the right incentives and removing the barriers that are holding back progress.
Exactly. And they're not afraid to push for stronger regulations. They want more transparency and stricter disclosure requirements so that companies have to be upfront about their climate risks and how they plan to address them. No more hiding behind vague promises or greenwashing.
I like their style, but it all boils down to this. Are they putting their money where their mouth is? They're clearly pushing for change at the policy level and investing in climate solutions, but are they willing to walk away from companies that are dragging their feet on climate action?
That's the million-dollar question, and it's caused some internal debate within the alliance itself. Some members are comfortable with divestment as a last resort, believing it sends a powerful signal and removes their support from companies that refuse to change. Others are more hesitant, worrying that it might be counterproductive. They fear that by divesting, they lose their leverage and their ability to influence those companies from within.
It's a tough balancing act. On the one hand, you want to put your money where your values are, but on the other hand, if you completely disengage, you might lose your ability to nudge those companies in the right direction. It seems like they're trying to walk that tightrope.
It's a delicate dance, that's for sure. But, this whole discussion about divestment and engagement brings us to a crucial aspect of their strategy. Those transition plans we keep mentioning. Remember, they're not just asking companies to reduce emissions, they want to see concrete plans for how they're going to get there.
Right, the roadmap to a low-carbon future. Tell me more about how those work in practice. What do these transition plans actually involve?
That's a great question, and it leads us to the heart of how the NZAOA aims to turn ambitious goals into tangible action. These transition plans are about more than just setting targets. They're about holding companies accountable and making sure those promises translate into real-world change.
This sounds like a good place to pause and delve into those transition plans in our final act. Stay tuned. All right, let's wrap up this deep dive with a closer look at these transition plans. They sound like a pretty big deal for the Net Zero Asset Owner Alliance.
They're absolutely central to the Alliance's strategy. It's where the rubber meets the road, turning pledges into concrete action. These plans are all about making net zero commitments more than just empty promises.
So no more greenwashing, just real actionable plans for change. What do they actually want to see in these plans?
They've actually laid out like a really detailed framework. It covers everything from setting ambitious but achievable targets to outlining, clear timelines and milestones. Importantly, companies need to disclose the financial implications of their plans. How much will this transition actually cost?
So it's not enough to say, we'll get there eventually. They need to show their work, demonstrate how they'll achieve these goals.
Precisely. They want to see detailed roadmaps outlining how companies will reduce emissions in line with those 1.5 degrees Celsius pathways. And it's not just about a company's direct emissions. They're pushing for them to address emissions across their entire value chain.
So looking at their suppliers, transportation, even how their products are used and eventually disposed of, that sounds incredibly complex.
It is a big task, but the NZAOA recognizes that. They're not just like setting these expectations in a vacuum. They've created tools and resources to guide companies through developing these plans, even offering, sector-specific guidance. It's about collaboration and support, not just issuing mandates.
So it's a more collaborative approach, helping companies figure out how to actually make those changes. But how can they be sure these plans are any good? Are they just taking companies at their word?
That's where accountability comes in. The NZAOA is pushing hard for transparency. They're encouraging companies to have their transition plans independently verified by third-party experts. This makes sure the plans are credible and based on the latest climate science.
So a reality check to ensure companies aren't, inflating their progress or setting unrealistic goals.
Exactly. And they're urging regulators to step up and create mandatory disclosure requirements for these transition plans. That would create a standardized system, making it easier to compare progress across different companies and industries.
It sounds like they're trying to create a system where everyone is playing by the same rules and held accountable for their actions.
Exactly. They want to incentivize genuine action, not just creative reporting. But we have to ask the tough question. At the end of the day, companies are driven by profit. Is there any evidence that these transition plans actually lead to better financial performance?
That's the million-dollar question, right? Do good ethics and good business sense actually go hand in hand?
It's still early days, but the evidence is mounting. Research suggests that companies with strong environmental, social, and governance practices, what's often called ESG, tend to outperform their peers over the long term. This includes companies focusing on climate change and those implementing robust transition plans.
So doing good can be good for business. That's a message more companies need to hear.
Absolutely. It's
Yeah.
not just about altruism. It's about recognizing the long-term financial risks of ignoring climate change and the opportunities that come with being a leader in the transition to a low-carbon economy. This has been an incredibly insightful deep dive into the world of net zero investing. I feel like I've learned a lot about how these big investors are trying to use their financial clout to tackle climate change. It's a complex issue, and there are still a lot of unknowns, but it's encouraging to see this level of ambition and action. Thanks for joining me on this deep dive. It's given us all a lot to consider about the role of finance in creating a more sustainable future.